Dispersion and correlation and dispersion trading. What is it and why should you care about it? We're going to talk about that today with a special guest today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Interest. So today we're going to get into a slightly more complex, but certainly a very important topic. We're going to be talking a little bit about correlation and dispersion. Some of those of you who have followed me for some time know that I traded dispersion back in the day, first in the oil service index, the cash settled index versus its constituents. And then later our firm sort of specialized in this kind of work in the late 90s and early aughts, trading primarily tech-related stocks against QQQ vol. But today we have a special guest who follows this, and I wanted to bring him in to talk about some of his insights and see what he's got for us. So, joining us, I have Garrett from Options Metrics. Garrett DeSimone is the head quantitative analyst at Options Metric. Welcome.
Thanks for having me back, Mike.
So for those who might be watching you for the first time on this, it would be terrific if you could introduce yourself and Option Metrics to the audience. Sort of a little bit about your background and what Option Metrics is, who you serve, and the kind of products that you offer.
Absolutely. So a little bit about our firm. We've been in business for 25 years as the premier options data and analytics provider. Currently, we provide options data such as Greeks, vols, volatility surfaces on US, Asia, Europe, and other major regions. So as a typical customer of Option Metrics, you would receive all of our calculations, including of our analytical package. And this is mainly provided to large institutional customers. Another side of our business that we've been developing over the last several years has been these option-based tools, which are derived from the options market. So today we're going to discuss a little bit about a correlation measure from our implied beta product, but we also have dividend measures that are implied from the options market, other signed volume demand indicators that are also implied. So we offer a wide array of tools to institutions.
Great. So, for those who are unfamiliar with the term, and probably everybody has some intuition about what dispersion means, but perhaps you could explain for the audience what dispersion is and what dispersion trading is in sort of plain vanilla language, if you will.
Yeah, absolutely, Mike. To keep it really simple, dispersion trades prosper when stocks move around a lot. So if we have a few stocks in our basket for our dispersion trade and they're moving all over the place, that's very beneficial to a dispersion position because it means correlation is low between the securities.
And I would take from that the inverse obviously would be of interest to investors, even if they don't trade volatility particularly, because what that would suggest is that stocks are trading sort of more in alignment with one another. And, historically, it seems like the pattern has been that correlation tends to rise at times when the market is under duress. And when correlations go up, that would suggest that the benefits of diversifying are somewhat muted and not as effective. Is that right?
Yeah, absolutely. So this is the notion that during periods of illiquidity or during crisis times that all correlations go to one. And it's the idea that there's nowhere to hide, as in you're not able to diversify away any of your risk. And that is really the worst case scenario for this dispersion trade.
So what are metrics that people can look at who are trying to familiarize themselves with this that will give them a sense of what's really going on? Number one, what the options market is implying, that is to say, is it expecting correlation to rise or fall? But also, how does one measure whether correlation is high or low from a historical perspective?
Yeah. So a little bit of background on the trade itself. An investor looking to structure a trade like this banks on the fact that you've got much more expensive index level vol compared to the constituents. So when we're thinking about how to measure kind of the level of correlation, we want to look at what the market is implying the correlations between the stocks and let's say the SPY basket are the S&P 500. So what we've done is looked historically and seen the relationship between what the market implies the future correlation between these stocks are and what actually ends up being realized. And we call this gap, this is the correlation risk premium gap. So the idea here is, and similar to when we're looking at trading vol, we want the premium reflects that implied correlation is more expensive than realized, and that's what these trades collect essentially.
So essentially, if your expectation is that correlation could potentially rise, then that would be a less attractive time, presumably, to be long single stock options and short index. And if you feel like index premiums are very high, then maybe that would be the time to initiate a short index like SPX or NDX or Russell options trade against a basket of long options in the underlying constituents. Is that right?
Yeah, that's absolutely right, Mike. And as we've looked historically in the last 2 years, this trade has really exploded in popularity. And what we've seen is that implied correlations as well as realized correlations have actually been structurally falling. And this has led to the narrative that there's been a lot of institutional money chasing this trade. So there's been some discussion of has this trade become overcrowded? Is this, is kind of the juice all squeezed out of it? So that's one of the things we look to study is how much excess returns can we achieve out of this trade, and is there a way to reduce the risk of your typical dispersion trade?
And well, I think that's something we'd all be very interested to learn about. So, I mean, is this an attractive trade right now? And how does one mitigate the risk associated with this? And actually, one sort of additional detail that I'm kind of curious about. Are you distilling this down to sort of a single number, like 1 month implied correlation? Do you look out on the term structure? Do you try to compare different periods on the term structure to one another to see whether there's a cycle of sorts or a seasonal effect where correlation is expected to be higher or lower?
Yeah, so for our first level of research, what we've really looked at is we're essentially taking the average of the correlate of the top 50 constituents and mapping their average correlation and calling that the implied correlation measure. We do this using our implied beta analytics, which we extract from the future, what the market expects the future correlations to be. So that is our benchmark for entering and exiting the trade. We compare this to a realized correlation measure. And what we find is that when the implied correlation relative to realized correlation is larger than, let's say, a threshold of 5%, it makes sense to stay in the trade, essentially doing your typical vanilla dispersion. However, when it falls below this benchmark, it makes sense to exit the trade and hold cash.
So it sounds as if this is a slightly more dynamic rule set than simply saying, oh, when implied dispersion or correlation gets to a certain level, then you initiate. You're really looking at the difference between what's going on in the market in real time versus what the market is implying for, say, the next 30, 60, 90 days, also in real time.
Yeah, absolutely. And this comes from the idea which we covered is that this difference between implied and realized is really the excess, your excess should be a measure of your excess return on the trade. And when that gap becomes very narrow, it means that profitability is nearly squeezed out. It could be a function of overcrowding. It could be a function of the fact that this risk just isn't compensated in the market. But it's during those times when we believe profitability of the trade is low, we want to exit and hold a cash position.
I think you have a couple slides for us. Maybe you can tell us what we're looking at here.
Yeah, absolutely. So if we look at this first one, this is just a measure of our 91-day implied correlation less the realized. And if we go to the very, very end of the chart, and one thing I should point out too is that we see during these crisis periods, typically if we look at 2020, we see a spiking or sorry, we see a negative realized minus implied correlation difference. So this indicates that implied correlation has become significantly higher than realized, and dispersion experiences losses. And an interesting thing about the dispersion trade, which is very similar to short volatility trades, is they have a lot of left tail risk. So this is one of those trades that'll accumulate positive average returns and then experience significant losses when we get these big drawdown periods. But if we look towards the end of the graph in late 2024, early 2025, we see that this measure has been contracting close to zero. So currently, what we see is that this risk premium has become much smaller than historically starting in, let's say, mid 2022 or early 2023. So this is an indicator to us that the profitability or the risk return reward to this trade might not be there currently.
Do you think this is possibly indicative, or maybe a little bit of a canary in the coal mine? I was talking to somebody earlier today. He was he's a real volatility trader. He was a member of the CBOE. He was actually one of the earliest VIX options traders. And one of the things that we were talking about as a part of the conversation was, why is it that the VIX is where it is, right? So the VIX is just a rolling 30-day. For those who are not familiar, I know Garrett is very familiar with this, but for those who are not familiar, the VIX is simply a 30-day look ahead, right? So it's effectively, you take a weighted strip of options in the SPX and derive an implied volatility number effectively from that. And one of the comments that he was making was that it seems as if 30-day volatility is not that great, but instantaneous volatility, day-to-day, intraday volatility has been pretty high. And we have seen that, haven't we? We've seen a couple days where we've had, triple-digit moves in the S&P. This tariff talk, for example, I think would be a really good example of things that have caused the market to move very, very sharply. Almost immediately that concern goes away. How does that play into the dispersion trade?
So it's actually very interesting, Mike. If we look back, I believe it was about 2 weeks ago, we had this big news out of China with DeepSeek, basically causing this turmoil in the U.S. markets for these companies with AI exposure. What was interesting about that, if we looked at the kind of the big players in the dispersion field, that really did the trade ended up being profitable on that day. And one of the reasons is the fact that we had this concentration of risk built up for these companies with AI exposure. But then we had everything else, your industrials, your consumer staples, with no exposure that performed okay on that day, which is what you'd expect if we've got AI exposed companies falling and we've got these other, your typical your Dow components increasing, you'd expect the dispersion trade to do pretty well. So I think in terms of some of these risks have actually been beneficial to the trade if we think about different types of exposure, let's say to tariffs. So some companies may have negative exposure to tariffs and perform poorly, but other domestic based firms might perform positively. That's actually beneficial to the trade.
Yeah, I think that's a really good insight. It's interesting because probably a lot of people don't realize they have a tendency to look at the headline index level. So if the S&P falls 100 points, 150 points, that's obviously an eye-opening number. And they tend to look at the biggest and most popularly traded stocks. So then you're going to talk about Tesla and Nvidia, Microsoft, Amazon, Mag 7 types of stocks. It may interest viewers actually to know that on the day that Garrett was referring to, I was taking a look, and 65% of the constituent stocks in the S&P 500 were actually higher that day. But the market was, of course, much, much lower, and that was in part because the stocks that were lower, all associated with the AI trade, tend to be the largest companies in the index, and the index itself is cap-weighted. So if Nvidia and Amazon and Alphabet are all trading lower, it's very likely that the market itself will also be lower. How does that play into your calculation? You mentioned that when you do this calculation, you're focusing on the top 50, and I'm assuming that this market capitalization issue is the reason that you do that. It's probably not that meaningful to look at the bottom 450 stocks in the index. Is that true?
Yeah, precisely. And there's some, construction reasons when we're thinking about building out this dispersion trade. We want to focus on a basket of constituents that has liquid options, and that tends to be the top 15, top 20 securities, which are the most heavily traded. So there's some practical reasons for it too. But also we focus on the larger subset because also these smaller weights are much more liquid and drive much less of the market return.
How basically how big does a book need to be to affect sort of a unit of a dispersion trade? I mean, using something like customer portfolio margin, I'm assuming that most of your clients are customer side, although I may be wrong on that. Maybe you're also servicing some of the market making community folks that are on JBOs, so essentially trading off bank balance sheets. But I mean, is this a trade that somebody with say $1 million in capital levered 6 to 1 would be able to affect, or are you dealing with? Is this something that probably requires more money than that to sort of put on a unit of the trade, if you will? And where on the term structure do you generally recommend that people do it?
Yeah. So as far as our customers are very tight-lipped regarding exactly how much notional they're allocating to trades, even the specifics of what they're into. They'll ask for analytics and our perspective on it, but very rarely do I get into insight into what kind of money is being put in to our customers. But just the complexities of the trade, it's going to be a very large book, and if we get around to discussing some of how this our portfolios are formed here, there's a lot of rebalancing that occurs. So these are typically very large, sophisticated institutions that are pouring a lot of money into it.
Do you see? I mean, I realize that it's not uncommon. I also worked at a hedge fund, and it's not that attractive a prospect to completely open the kimono. If you feel like you have any edge, you want to try to keep that to yourself. But of course, as an important data provider to them, you're going to have surely you're going to have some insights, I would imagine. Are you seeing, say, for example, traditionally what might have been thought of as a long short U.S. equity, large cap book? Do you see institutions like that migrating into these types of strategies to basically diversify the strategies that they're offering, mute volatility in some of their conventional strategies? Or is this typically being affected primarily by more quantitative shops, the D.E. Shaws and folks like that?
So my intuition is that this tends to be more quantitative heavy, in just the fact that there's really a deep understanding and mechanics of the options markets required here to put on this trade. So it tends to be more, at least in my conversations, tends to be more quantitative and more options focused funds.
Uh, and if you're looking at the information that you have here, how might folks who are not actually doing the volatility trade, think about taking a look at this either as a measure of risk, as I guess maybe we could think of this as not necessarily another fear index like the VIX, but it has some similarities. Understanding how high implied correlation is, presumably if implied correlation is much higher, then the assessment of risk going forward, whether it's 30, 60 days, however far ahead you're looking, is also higher. How do you think that investors who might just use options for, say, overwriting strategies, there's a lot of folks, for example, both retail and institutional. On the institutional side, even some big shops like Omega and Glenview. These are firms that don't trade vol per se, but get into big equity positions and overwrite. They'll sell strangles typically. They'll sell an upside call where they're willing to be pulled out of their stock. They'll sell a downside put at levels where they might add to an equity position. They don't have that much of a deep understanding in trading volatility. How can they use information like this to sort of help inform them whether it makes sense either for them maybe not to be doing that trade, or to consider hedging. I would assume if implied correlation is really really low, that maybe that would set up more favorably if there's you're selling strangles, that maybe it's more favorable to buy a little bit of index downside protection because on a relative basis compared to the premium that they're selling, it's kind of cheap. Is that a fair take?
Yeah, absolutely. And I think it fits well if for some of these funds they're looking at it in terms of their overall exposure, right? So they're running several different, let's say, covered call strategies, several different strategies that you mentioned that they've got strangle positions on. It's good to get an understanding of, let's say I'm short, let's say I've got the Mag 7 and I'm short strangles on all these, just as an example, short strangles on all these, right? So I do have this kind of exposure by buying an index put or sorry, an index straddle. I can kind of get it net out some of this exposure that I've got from running these positions across all my individual components, right? So it's correlation is almost like the hidden risk that not the hidden risk, but it's a risk that's very difficult to measure in some cases, right? But it's something that should be thought about, I think, a little bit more when it comes, at least in terms of the options, using it as an options measure. Because what we've seen is that there's these models of realized correlations, which work well, but if we're able to extract something that's forward-looking here, I think that could present a huge advantage for hedging out some of the broader portfolio risk.
I think you had another slide for us as well. I don't know if we showed that one. So yeah, I saw this one already. Ah, yes. So this is Okay, so this gives us a sense then of the returns that one can divine from a strategy like this, or has been done historically.
Yeah. So this is we looked at three separate strategies. First two are vanilla dispersion trades. So these are they're Vega neutralized every day. Basically, that just means reallocating the portfolio so it does not have any broad volatility exposure. But we looked at a trade that rolls every month. A trade that sorry, a 1 month trade, 1 month options that roll once a month, 3 month options that roll once a month, and we saw that we actually got better performance if you're holding a longer term option like a 90-day option when running this dispersion trade. And then we used our active strategy, which we discussed earlier, which deactivates when this risk implied correlation and realized correlation gap becomes negative. So the in our terms, the trade has been squeezed out or the trade has kind of been pushed to the brink.
Is that the green line that I'm looking there then? So
That would be the green line, the best one.
so so that's not 90 days, but dynamically adjusted. So you're in the trade, except when your metrics suggest that maybe the juice isn't worth the squeeze, as they say sometimes.
Yeah, precisely.
How do you normalize volatility? Uh, the vol of one constituent stock presumably doesn't behave in a linear fashion with the volatility either of other stocks inside the basket or the index itself. What's your approach to normalization? Is it a ratio, something simple like that, or is it a little bit more nuanced? What's the method for normalizing volatility? You were talking about adjusting and making sure that you're balanced in that respect.
Yeah, so we use a simple ratio here because we like to we'd like to focus on really the idea of how a very like the most vanilla trade you could think of, which is even pretty complex. But we just say let's make sure the vega of our short positions equals the vega of our long positions here. The vega of our short index position equals the vega of the long individual straddles.
Well, that's good news actually, because that suggests that you don't have to get overly complicated with the strategy to get decent risk adjusted rates of return by simply taking a relatively systematic approach and enhancing it with a simple input or two, such as the metric that you describe.
Yeah, absolutely. And one of the fascinating things about the trade is I'm sure every shop has a different way of approaching it. There's even more sophisticated ways of doing it, such as reallocating your weights towards the individual constituents, or even the constituent selection. We made a very simple decision to pick the most liquid or the biggest constituents in the S&P. But you could get really down into the weeds and select any number of constituents based on certain kinds of measures, whether it's pairwise correlations, things of that nature.
All right. Well, before I let you go, I'm going to put you on the spot here just a little bit. This is proving to be quite an interesting beginning to 2025. I would have to say. We have a new administration, and that new administration is acting with some haste to effect the promises that they made before they got into office. I'm saying they because it seems like there was basically an entire alignment of Trump and all of the people that he had around him. It was not like he was going and hunting for potential candidates to fill out his cabinet. They were pretty queued up and raring to go by the looks of things. And I don't know whether they're breaking things, but they're certainly going out and making some very fast changes. And we're kind of getting whipsawed by things like, I'm imposing tariffs on Tuesday, and I'm going to delay it by 30 days because you're going to enforce your side of the border. Now we have Japan. They're meeting with the Japanese on things like tariffs. I'm curious if you were in this environment with this stuff going on, and I'm going to just give a little quote here because it occurred to me as I was watching some of this stuff. Bernard Baruch, was a famous financier from many, many years ago. There's actually City College in New York. Their business school is named after him. And I don't remember his exact quote, but it was something along the lines of the following: that the main purpose of the stock market is to make fools of as many men as possible. And I'm starting to think that Donald Trump may have taken that to heart, and he's trying to make fools of as many of his critics as possible, and it's very difficult to keep up. When it's difficult to keep up, that's one of the things that's going to contribute to day-to-day volatility. So as you think about it, and you're saying I could be long correlation or I could be short correlation here, or I could be whatever strategy I'm running, I could lean a little short. What's your take right now? If you could put this trade on, or if you could say hedge at least just one side of it, because there are some business leaders, aren't there, who have said, they think this is, as he has said, a golden age for business. This is the most business-friendly administration. And so there's a lot of bullishness associated with that business friendliness. And there's a lot of bearishness associated with the fact that it's very difficult to keep up with policy. And those policy shifts have really important implications. So what do you think that does to the dispersion correlation trade and also on the hedging side? How would you approach it?
Yeah, from looking, kind of broad in a broad macro sense, I do think kind of these rapid fire policy decisions are going to contribute to volatility in throughout the year. But it's very interesting, and I forget where I heard this take from, but when talking about tariffs, the market I think has kind of processed that it's more of the threat of tariffs than actually imposing tariffs. And I think the market has come to understand that the threat of tariffs have become more of a negotiating tool. And that's why we've seen kind of this rapid whipsawing. We'll get the announcement of tariffs, and then like within 12 hours it's retracted, and we've got a 30-day kind of stay, right? So in terms of how I view it in the context of the correlation trade, I think even though what we've seen is correlations are still pretty low, and the gap between implied and realized correlation is still pretty tight, these policy decisions are going to have kind of asymmetrical effects for different economies across the firm. And it's actually something we're pretty interested in researching is, are there certain firms that are more exposed to trade policy risk? We know there are, but we'd really like to get a quantitative measure of that from the options market. But how that feeds into the correlation trade is ultimately when you have these policy decisions and, similar to what we saw with, the threats against Canada and Mexico, and then the rebound in the market is some firms have a lot of exposure to Canada and Mexico and will perform poorly, while other firms or domestic-based firms do not. And they actually may end up being long-run beneficiaries of this. But ultimately, that adds to the profitability of the trade. So uncertainty, strangely enough, uncertainty in policy, I believe, actually supports lower correlation.
Yeah, so that's yeah. I mean, that sort of goes to you might, I guess, one thing that people could potentially do. Also, I mean, I'm going to assume that for many of the people who are watching, their portfolios are not constructed, as a mirror. They're not. Let's assume that they're not closet indexers. So a closet indexer would have underlying weights that are consistent with that of the S&P, and therefore construction of functionally the construction of a dispersion or correlation trade. I'll say dispersion meaning your long constituent vol, short index vol, and correlation your long index, short constituent. I think that most of the people who view this basically just have a general portfolio of stocks, and in addition to that, they are probably a lot, in many cases, premium sellers. I don't know if we have someone's trying to ping me here. I'm just going to quickly see. Maybe we have a question. Okay, so maybe we can put that up. I should actually have queued up my thing here. So Garrett, we have a viewer named Jay Bao. He says, how well might dispersion trades work on individual stocks such as Tesla? So I'm trying to think what you might mean by that, Jay. When you ask that question, are you asking whether you can try to trade? I guess that's kind of a pairs trade question, isn't it? That's more like a pair, and not even a pairwise against other constituent stocks. I guess he's saying, can I own Tesla vol short index? Do you look very much at the relationship between individual stocks volatilities and the index as well? I guess that would probably be the way to approach this. Is that something that Options Metrics does? Come up with a ratio number so you can kind of think about, for this much long Tesla vol, I would be short this much index vol, even though you don't functionally
Yeah.
create the dispersion trade.
Right. I mean, a way of thinking about that too is kind of what is Tesla's beta, in other words, right? Or Tesla's kind of eh, Tesla vol exposure to market vol, in other words. So we do implicitly build some of that into our modeling, but the notion is, right, let's say if we're interested in how much Tesla vol responds to market news, for example, that might I think that's kind of the context. If let's say Tesla doesn't Tesla's correlation with other stocks maybe falls apart, right? Or it separates itself. That might be something we're interested in looking into, or kind of reweighting our basket in terms of what makes up our dispersion trade.
Actually, yeah, you were just talking about beta. I mean, I guess there's the beta of the two underlying assets, and then one could think of a sort of a vol beta too, right? Which is the ratio, the rate of change in volatility, implied volatility for Tesla versus change in the underlying constituent index, that kind of thing, right?
Right, absolutely. So that's another, depending on what exposure you're trying to target, that's another. If it's market risk, or let's say like and exposure to market vol, these are two separate risks.
Oh yeah, so yeah, there's a very specific. The viewer actually followed up on that question and was actually relating Tesla to other mega caps like the mags, basically. So yeah, that's a good thing to think about. Okay, so we have someone else here on the first chart. It looks like the dispersion was lower in 2022 than in prior years. Is this because, as you mentioned, the trade is more crowded, or was 2022 an anomaly? I need to actually, I'm going to pull this onto another screen so I can get a closer look. I want to see the chart that you have there. So this is the first one. 20. Oh, that chart goes back quite a ways. So 2022. 2022, of course, that was a down year, right? So most years are higher. 2022 was a down year. Remember, the markets. This is just my own comments. Then I'll let Garrett bring it up. And that was that, we started to get into the rate hike cycle, and we had a pretty steep sell-off in the major indices off of the January highs. So there was a number of stocks that hit highs at the very beginning of January and then rolled over, and it was a pretty tough year overall. That which brings up, and I guess that might be Eileen's question, which is, what is the relationship over a longer period of time? Instantaneously, if there's something like that the market doesn't foresee, and you have a big washout like the crash in 1987, for example, or the flash crash, you would expect to see volatility correlation go essentially straight to one in that environment, or the GFC. Everything gets washed out. But what about these declining markets? A period where you have a prolonged rate hiking cycle. There's just general heaviness and weakness in equities that persists over 6 to 9 months. How does that impact the trade?
Yeah, so going back in time a little bit, if in 2022 there was a lot of upset hedgers in the sense that really had this bear market for equities, but vol was actually falling during that time period. So a lot of these long vol trades were actually just bleeding out throughout the year, and we had poor performance in equities, poor performance in bonds. But as it turns out, even though we had this bear market, correlations were actually largely falling, which had been brought up as almost an anomaly. And there were, even in the academic literature, there was a quest to find, we've got this bear market, but we've got falling correlations and falling vol. But one of the reasons that this trade has become so popular is it's really an uncorrelated source of alpha for a lot of these large institutional funds, in the sense that we have this situation where correlation was falling, and this trade was very profitable while everything else, equities, bonds, were going the opposite direction, right? So this is a reason why it's really become a boon, in the sense that these institutions are going to something that traditionally does not have market risk, is not associated with, let's say, kind of credit risk. So 2022 to wrap that up, 2022 was an interesting period. So even though the market's falling, correlations can also be falling.
And that actually would be the reason why this would be a very nice adjunct to a portfolio that otherwise was, because that was actually a very tough year for, say, the conventional sort of 60-40 allocation, right? So we had very weak equities that year, but rates were skyrocketing, so fixed income was also taking it on the chin. Very little diversification in a straight long delta book, regardless of the asset class you held. So a strategy like this seems like it would be very nice to allocate to, because you have, as you point out, this uncorrelated asset. Well, I'm actually going to ask you one other question, which is coming completely out of left field, and is not related at all to the dispersion correlation thing, but it's more related to what you're doing in option metrics and the things that you look at. And it also is a little bit related to the Trump administration. So the incoming administration has indicated that they are very friendly to cryptocurrencies. And now we're starting to hear and get sort of a normalization of crypto within the conventional banking sector. And we've seen a lot of crypto products that are hugely active on the options side. So, for example, not that long ago, they listed options on IBIT, which is one of the crypto ETFs. Obviously, options on MicroStrategy are very actively traded. And then you have a lot of sort of trades that are close to it, right? So they're not exactly functionally related to the crypto like Bitcoin necessarily, but are certainly related, like Coinbase and things like that. So are you guys doing much on the crypto side and analyzing the relationships between these types of things?
Yeah, absolutely. So if it's traded on an exchange, if it's cleared by an exchange, we calculate the volatilities for it, we provide the prices for it, and we actually build out futures Bitcoin vol surfaces, which are very interesting, and we could probably do another podcast on that altogether, the dynamics of what a vol surface looks like Bitcoin versus some of your other traditional commodities. But we're working on modeling all that, and something that I think is probably going to become, as Bitcoin again tends to trend towards normality, right, or acceptance in the financial community, it'd be very interesting to start thinking about how some of these firms have Bitcoin exposure risk, right? So we've got all these traditional risks. You've got beta risk, for example. You have your exposure to your typical, Fama French factors. But we're interested, these companies that are exposed to the crypto market. What kind of risk are they carrying? So that's I think a really interesting topic and something we're looking to pursue.
Yeah, I mean, I actually happen to have a good friend who started a couple fintech companies who's starting a crypto volatility hedge fund. And I think it would be great to get both of you onto a podcast and talking about this as a topic because I think there's going to be a lot more. There hasn't been as much need for or focus on options in the crypto space, even though they are heavily traded as the underlying asset. Number one, because the underlying assets themselves had such significant volatility, and also because, to your point, they hadn't been completely normalized within, the conventional ways that people trade, especially people who trade equities, right? So they may or may not have had access. There was no really good mechanism for people who wanted to run a portfolio to cross margin, for example. So if you traded, if you had Bitcoin in a wallet that could not serve as an effective hedge against, say, short options on IBIT. But now that as everything sort of gets more normalized and lands on single platforms and trade like equities or trade like futures, or there's cross margining between equities and futures, that really opens up a lot in terms of cross asset volatility trading. And I think that's going to be a really interesting and exciting area. So I'm looking very much forward to having you back for that. So I'm going to hold you to that. We can have a
Absolutely.
conversation about it. So I hope those of you who are watching found this helpful and will come back and join us again when we get Garrett back, along with my friend Scott and maybe Brian Kelly, who is another good friend of mine who runs a crypto fund. I think he's now based in Wyoming, which is a very friendly place for trading crypto. And have a further conversation. But I hope you found this helpful. Think about the volatilities of the individual stocks that you trade, even if you're not going to start engaging in the dispersion and correlation trade at this point. I think there's a lot of valuable information that you can divine about the risks to a diversified portfolio as a function of the relationship of the constituent stocks in that portfolio. And Garrett, as always, your insights are welcome. And also your insights on the economic picture, because probably people don't know that that's actually what you have your PhD in, is economics. Isn't that correct?
It is. I like dusting off the degree occasionally. I
And
spend
we
a
like
lot
to
of
get
time
your
in the,
insights when you do.
the depths of option pricing, but it's nice to get back to my roots in economics.
Well, we'll try to get more of your insights on that side the next time we have you. And until then, have a great weekend. And all of you, thank you very much for watching, as always.
Thanks, Mike.